All right, welcome. Hey guys, you're at maximizing property profits with cost segregation, which means we're going to be talking taxes. And I'm going to introduce Erik Oliver, who's going to be presenting today. If you guys don't know Erik, first off, welcome, Erik.
Thank you. Glad to be here.
Yeah, we've worked together for many years now with his company, Cost Seg Authority. And they've done a fantastic job for our clients. In fact, I'll probably start picking your brain on picking some clients to see who you've worked with and helped without violating anybody's confidentiality. But I always like to put Erik on the spot. And today, what we're going to do is go over the concept of cost segregation, what it is, how you use it as a real estate property owner, and how it could actually put more money back in your pocket much sooner than later, like really accelerating the amount of deduction you get on those properties when you acquire them in those first years, so that you're not stretching it out over 39 years, 27 and a half years, and really seeing, stretching out that 3 decades from now getting a benefit. No, I'd rather get it today and really get those tax savings into our pockets so that we can continue to invest. It's never been more important, probably nowadays with high interest rates. And I say high interest rates, but anybody who's been around for, longer than a few decades knows that these aren't really that high. If you remember the 80s, they were extremely high. We've had plenty of times when we had higher interest rates, but compared to recent times, yes, the interest rates are a little higher. Lack of affordability in real estate, and people really having to make a crunch decision as to whether they're going to be a renter or whether they're going to acquire a home. And so all of these tools we need to use as landlords and as investors so that we can help out and make that decision easy for somebody who's really on the cusp, but where they can remain a renter, great quality homes, and continue to do a good job by supplying, again, great homes for people to use, whether it be commercial or residential. And so this is going to be really interesting today. So Erik, what are you going to cover today? Just you have a presentation. I'm sure you might want to share it
Oh yeah, let me pull it
uh,
up.
so I can see that, make sure that it's working. Oh, and by the way, folks, while Erik's doing that, we do have Jeffrey Stolken, one of our accountants, in the background answering Q&A. I'll be answering questions. Yes, we will make a recording of this and share it, I'm sure. Kate, is that true? Just type in the chat, let me know. And then, so when you have questions specific to your situation, if you could, go ahead and put that into the Q&A. Now, if I ask you a general question, or if Erik asks you a general question, by all means, feel free to use the chat. Sometimes I'll say like an emoji, like if you're alive and hearing me right now, give me a thumbs up emoji. Just do that now, or a heart, or crying face, scared emoji, whatever it is, so that I know that you guys could do that. So sometimes we do that. And sometimes we say things like, hey, in chat, could you just type where you're at, city, state, where you're at? We have a big group on, by the way, Erik. Like, this is pretty amazing for a tax event to have this many folks joining us. But put in the chat what city and state you're in. And somebody says Las Vegas, Nevada. Me too. Lake Oswego, Denver, Austin, Texas, Boise, Idaho. There's another Vegas, Crownville, Maryland, McLean, Virginia. Now they're going too fast. Dallas, Lakeland, Bentonville, Atlanta, Kansas City, Tacoma, Washington, where one of our main offices is, Napa, California, Oregon, Berkeley, Hawaii. This is awesome. Like just all over the place. I always love it when the Hawaii guys got on, by the way, because when we start, this isn't too early, but still pretty darn early for you guys. You guys always get a big star, but it's so beautiful there. So I could imagine that it's just great getting up. There's Alaska, and we got Florida, we got New Zealand. Okay, that's probably the person who's the farthest away. Sun River, Oregon. So we just have a really good group. Now we're talking about U.S. taxation, so our friends from out of the country. It's for if it's when you have property in the U.S. But we are talking about. Well, actually, you could technically, I imagine, you could get some cost seg even on properties outside the United States if you're a U.S. resident that owns them. Never really thought about that, Erik. But this is what we're going to be going over today: maximizing the profits that you get from your real estate investing by accelerating that. those deductions using cost seg. And so if you've ever heard the term bonus depreciation, bonus depreciation comes along in real estate by using a cost seg study first. And so if you're going to unlock those benefits, you really got to know what both are. And thank God we have an expert with us. Erik, again, thank you for joining us and tell us what you're going to go over today.
Yeah, thank you, Toby. So you hit it on the head. We're just going to talk about mostly cost segregation. So a lot of you have probably heard the term. Some of you may understand it. Some of you may not understand it, but we'll go a little deeper dive into what cost segregation is, and how it applies, and then go through some of the myths and misconceptions. There are a lot of myths around cost segregation. There's been a lot of changes to the tax law. So some of those myths were actually true a number of years ago, but because of some of the changes, that's not the case anymore. So we'll talk about that. We'll go through a couple of case studies. We've got a case study of an actual Anderson client that we'll go through and talk about how we were able to help save money there. We'll go through some specifics there. And then if we've got time, I do want to just touch on 179D and 45L. I've only got a single slide on each of those, but they're probably two of the most underutilized tax credits and deductions in the real estate world. And so just being aware of that, we won't take a deep dive. We could do a whole presentation around each of those, but just wanted to make you guys both aware of both of those because I think it's important. Like I said, they're probably two of the most underutilized deductions and credits in real estate. So
Hey, Erik,
yeah.
fantastic. We're going to go for about an hour on this main presentation, then we're going to do Q&A. So we're going to pop in. What I'll do is excuse myself here in a second, let Erik do his thing and really get into the nuts and bolts and the meat of the presentation. I'll come on and I will flag some of your guys' questions if you have them, put them in Q&A. If you want clarity or if you have, you want to, it's like a difficult question, I'll flag those so we can ask Erik in the Q&A. So we can do some deep diving to make sure that all your questions are answered today, guys. It's really important to us that when you bless us with your presence, makes a big difference to have people live on these, that you guys get some special treatment. So you get to ask a bunch of questions for absolutely free, and you're going to have an expert here who's able to answer them, who's done. How many of you cost seg studies have you guys done at this point?
Just over 25,000. So getting up there.
5,000 cost seg studies. We've done a ton of them with you. Love the fact that you have that much experience. So I'm going to hand it to you, brother. Take it away.
Okay. All right. Sounds good. Well, thanks again, Toby, for the introduction and the opportunity to be here. Just to kind of back up a little, I probably should have started. As Toby mentioned, my name's Erik Oliver with a company called Cost Segregation Authority. You'll see up there in the logo, we actually just went through a rebrand process in February. So technically, I guess we're called Cost Segregation Authority Partners or CSAP. I like that better than Cost Seg Authority because my email is much shorter now, which has been great. But we've been doing this for about 20 years. As I mentioned earlier, we've done about 25,000 studies. A little bit about the company. We were founded by a father and son. Father was a CPA and the son was a developer. And those are kind of the two skills you need in order to be able to do cost segregation and do it effectively. And so we have a little different methodology than some other cost segregation companies, where we look at it more through the lens of a developer or through a construction lens versus just the tax side. And I think we're able to get a little better benefit by doing so. And we'll kind of go through some examples here on why that is. But to get started, again, we're going to talk about what cost segregation is. Like I said, a lot of you have probably heard the term, maybe even listened to podcasts, webinars on cost segregation, but we'll take a little deeper dive. Then we'll talk about some of the myths and misconceptions around cost segregation. There have been some major changes to the tax law, and it sounds like from the president's address to Congress the other night, there might be some additional changes on the forefront. We'll talk about those as well. And then, like I said, well, if we have time, we'll get into 179D and 45L. Again, I just have a slide or two, but wanted to make sure that you guys are aware of that in case any of the projects you're working on fall under any of those tax laws there. So with that, what is cost segregation and why is it important? And so cost segregation really is just accelerated depreciation on your real estate assets. So one of the great benefits of owning real estate is the ability to take this non-cash expense against your income. And the IRS allows us to do that. They call it depreciation. And what it is is the idea is that your building is deteriorating over time, and the government or the IRS is going to allow you to take that deduction. Now, building values may be going up, but the building structure itself is deteriorating over time, and they let us write that off as an expense. Now, residential properties, anywhere where somebody lives, single family homes, apartments, senior centers, student housing, those get depreciated over 27 and a half years. And commercial properties get depreciated over 39 years. So just to make the math easy, if you have a $275,000 home, you buy it, you basically take 275, divide it by 27 and a half, you're going to get a $10,000 write-off every year. Now, I've oversimplified that a little bit because land is non-depreciable. So when you buy let's call it a single family home, you're buying the building and the land, we always have to back the land value out. But whatever's left, whatever value is left in that building, that gets depreciated in that case over 27 and a half years. So again, if that's 275,000 divided by 27 and a half, you're going to have about a $10,000 write-off every year for the next 27 and a half years, which is great. That means I get to reduce my taxable income by $10,000, which means I'm going to pay less tax. Now, the problem with that is I'm probably not going to own my property for 27 and a half years, or let alone 39 years on a commercial property. And so I want my deductions now. And the way we're able to do that is through an engineering-based study where we can go into the property, review the property, and identify assets within that property that should be depreciated over a much faster useful life. For example, there is something called 1245 property, which is kind of called your personal property. That's the stuff on the inside of the building. That's your flooring, your carpet, your cabinets, your countertops, your appliances, ceiling fans, window coverings. All those things the IRS says, hey, they don't last 27 and a half years or 39 years. They last 5 years. Then we've got our outside stuff. You can see behind me here, the parking lot, for example, is a 15-year asset. The curbs, the gutters, the asphalt, the sidewalks, trees, bushes, shrubs, retaining walls, fencing. Those are all 15-year land improvements, and they should be depreciated over 15 years, not 27 and a half or 39 years. So just as our name implies, in cost segregation, we're segregating the cost into different buckets, which allows us to front load or take a much bigger deduction in the early years. Now, why would you want to do that? Well, obviously there's the time value of money. A dollar today is worth way more than a dollar in the future. And so I want, again, my deductions now versus letting the IRS hold on to these for 27 and a half or 39 years. The other reason I want these deductions now is I may not be planning on holding the building for 27 and a half years. So I want to maximize my cash flow now so that I can get these bigger deductions, create additional cash flow so I can then go buy another duplex or pay down my debt or buy Bitcoin or whatever it is I want to do with my tax savings. I have the ability to get that money out of that home through depreciation, through tax savings, and then reinvest that money at a much faster rate, which again, long-term helps build wealth. And so cost segregation, like I said, it really is just accelerated depreciation, and it's being able to accelerate it through an engineering-based study. Go to the next slide here. Let's talk about some of the myths around cost segregation. Like I said, these myths, I believe, have come about, most of these have come about due to the fact that these were actually true, 5, 7, 10 years ago. But with some of the changes to the tax law, a lot of people are still under the impression that some of these myths still are in effect. And so we'll go through each of these. The first one there is cost segregation is only for large commercial properties. So again, in the past, that is absolutely true. When I started doing this 8 years ago, we primarily only worked with large commercial institutionalized investors. So people who were buying hotels, hospitals, casinos, large apartment buildings. The reason for that is the cost of the study was significantly higher and the benefit was significantly lower than it is now. And so you had to have a large property, usually over about $1 million worth of depreciable basis. Again, that depreciable basis is your purchase price minus your land value. So if you had a property over $1 million of depreciable basis, it was probably a good candidate for cost segregation. Well, with some of the changes to the tax law, specifically bonus depreciation, which we're going to get into here in a minute, bonus depreciation essentially puts cost segregation on steroids. And because of that, cost segregation is now applicable to a lot smaller investor. So now we do everything from single family rental homes, basement apartments, all the way up to large commercial buildings, casinos, hotels, etc. And so, again, because of those changes, I still hear tax preparers tell me or tell clients, hey, your duplex isn't a good candidate for cost segregation because it's simply too small. And that's not necessarily the case. So keep that in mind. Number two is that cost segregation is limited to just new construction. So if you think about it, when you construct a new building, you should have invoices or construction costs for every component of your building. You know exactly how much you spent on the flooring. You know exactly how much you spent on the asphalt. And so new construction is, I don't want to say it's easier because it's actually more complicated for us in a sense, but it's easier to identify the costs of those assets. However, the IRS does allow us to do cost segregation on assets that are acquired that were built in a prior year. So for example, let's say I buy this office building today. This office building was built about 10 years ago. But if I buy this office building today and do a cost segregation study, a cost segregation professional can come into the building and say, and do an estimate on what the carpet is worth, what the parking lot is worth. And so cost segregation works for both new construction and acquisitions on properties that have already been built. Number three, a study must be completed in the year of acquisition. And again, that's just not necessarily the case. The IRS allows us to go back and do cost segregation on assets that were placed into service or that were purchased in prior tax years. So for example, if you bought, let's say I bought this building in 2017, I never did a cost segregation study. I was taking my 1/39th of a deduction for the last, what is that, 8 years or so. I can now do cost segregation in the current year, take all that missed depreciation and drop it on my current tax return without having to amend any prior years. And we'll get into an example of this. It's kind of interesting. When you do that, you're actually doing it the correct way. Now, the IRS isn't going to come after you if you're not depreciating your carpet, for example, over 5 years, and instead you're depreciating it over 39 years. They're not going to come tell you, hey, you're not taking a big enough deduction. They want to hold on to that cash and hold on to that tax savings. But essentially, you're doing it incorrect if you're not segregating these different components out. And I believe the reason they've allowed this to happen is in the past, it's very difficult. You know, if you think about kind of the buying process, when you buy an asset, you get a closing statement. So let's say I buy this office building for $1 million. I get my closing statement. I give that closing statement to my tax preparer. And my tax preparer has no idea, one, if there's even carpet in this building because they've never been here. But two, they certainly don't know what the value of the carpet is. They don't know what the value of the partitions are. They don't know what the value of the lighting is or the parking lot. And so the IRS has said, hey, just group everything together as building and depreciate it all over 39 years. But again, when you have a cost segregation study, that's exactly what we do is we identify those short life assets, put a value to those, which allows us to depreciate it at a much faster rate. And then number four here, cost segregation studies are complicated and expensive. I will say they are somewhat complicated. The good news is for you guys, again, you don't have to do these on your own. Even CPAs, most CPAs, EAs, tax return specialists, or tax preparers, they don't do cost segregation. So they'll partner with a company like ours to do this on the back end because you do have to have not just the tax knowledge, which they certainly do, but you also have to have the knowledge of how construction works and how buildings are built. And so oftentimes your tax preparers, your CPAs, your EAs, they don't have that knowledge. And so they will partner with a company like ours to be able to do these studies. So yes, they are complicated, but that's why we've got experts doing it. As far as being expensive, they were in the past. The cost has come down significantly over the last couple years, simply due to new technologies, number one. Number two, with bonus depreciation, I feel like there's a lot more cost segregation companies in the marketplace. And so cost has come down a little bit. But usually we're seeing a 7 to 10x return on your investment at a minimum. So again, if we're charging you $3,000 for a study, we want you to save, $30,000 in taxes. And so usually it's well worth it. And whenever you're doing cost segregation. So number 5 there, the benefits are offset due to recapture tax upon sale. This may be the most complicated thing we talk about today, but when you sell an asset, you pay 2 types of tax. You pay depreciation recapture, and you pay a capital gains tax. Depreciation recapture is calculated based on how much depreciation you've taken. So I'm sitting here saying, hey, let's front load or take as much depreciation in the early years as possible. And then we'll have sometimes tax preparers come back and say, well, why would I want that for my client? If they take all this depreciation up front, they're going to have a bigger capital gain and recapture bill upon sale. And the answer is that's not necessarily the case. And I'll kind of walk through an example because I think it makes more sense. But think about it this way. If you were to buy, again, I'll use this office as an example. I buy this office condo for $1 million. I own it for 5 years. 5 years later, I sell it for $2 million. So when I go to settle up with the IRS, I'm telling them that everything has doubled in value. I bought this building, these walls, the land, the carpet, the parking lot, all this stuff inside. I bought it all for $1 million. 5 years later, all this stuff I'm selling for $2 million. And therefore, they're going to say, you've had a gain on that. It's doubled in value, and we're going to charge tax on that. Well, my walls have gone up in value, and maybe the land has gone up in value, but certainly my dirty stained carpet, for example, is not worth double what I bought it for. But when you don't do cost segregation and you just group everything together, you can't pull out the different components of your building. If you remember, I said earlier, carpet is a 5-year asset. So what is the book value of my carpet after owning it for 5 years? Well, it's zero, has no value, no book value. And so I should be selling my carpet for a very minimal cost, and I should be selling my building or my walls for a lot higher cost, which means I'm moving that depreciation recapture over into the capital gains bucket, and capital gains is taxed at most 20%. So I do my cost segregation study this year. I get my deduction against my ordinary income rate of, let's call it 35%. In 5 years, when I sell my building, I'm going to pay some of that back at a 20% capital gains rate, or at most a 25% recapture rate, and I'm going to save the spread. And so that's why oftentimes we'll work with commercial real estate brokers and say, hey, if a client comes to you and they want to sell their building that they've owned for 10 years, they bought it 10 years ago for $1 million, they now want to sell it for $2 million, we'll walk them through this exercise and say, hey, they really should do a cost segregation study right before they sell the building, because we want to be able to take advantage of this rate arbitrage where we, again, take our deductions at a high rate, pay back a portion of it at a lower rate at a future date, and save that spread. And so again, if someone tells you, hey, you shouldn't do cost segregation because you're just going to have to pay it all back, I would invite you to run the numbers and let's see if that rate arbitrage makes sense. I'll let you know right now, on smaller assets, that rate arbitrage might not make sense. So if you bought a property for 100,000 and you're going to sell it next year for 150, it's probably not a good candidate for cost segregation, because we're going to get you a $4,000 tax savings this year. You're going to have to pay 2,000 of it back next year when you sell it. So you've only netted 2, but then again, if it costs you $3,000 to do the study, you're really behind $1,000. So those are kind of the conversations we'll have with the clients as we walk through some of these scenarios to make sure that there is going to be significant tax savings before we ever engage a client. And the last thing there is just that cost segregation is a tax loophole. We're seeing less and less of this misconception. I think there's enough podcasts, there's enough webinars out there. The message is getting out that cost segregation is in fact a legitimate way to reduce your tax liability. The IRS has even given us an audit guide that tells us how to do cost segregation and what steps we need to follow. And so it's not like we're doing something behind the back of the IRS. They're very well aware of cost segregation. They just want to make sure it's done correctly and that you're not just, spitballing these values to the different components of your building. So Let's talk quickly about the preferred methods of cost segregation. This is actually directly from that audit guide that I just mentioned. The audit guide tells us that there are 6 preferred methods to do cost segregation. So again, straight from the audit guide, the first 2 say a detailed engineering approach from actual cost records. So that's the most accurate. So again, you build a brand new building, you've got all your invoices from your contractor. We're going to go through those invoices and allocate those to the right buckets. We're going to take your indirects, we're going to apply those. And that is the most accurate way to do it. We've got actual cost. Number 2 there is a detailed engineering cost estimate approach. And this would be if you buy an existing building, we don't have invoices for the parking lot, the carpet, etc. So we're going to have to go in and use a methodology to estimate the costs of those different components. That's what we do here at Cost Seg Authority, is we do a detailed engineering approach, whether it's based on actual cost or cost estimate. There's a couple other methods to do it. I want to skip down to number 6 there, which says a rule of thumb approach. Now this is again straight from the audit guide. It says an examiner should view this approach with caution since it lacks sufficient documentation to support the allocation of project costs. So this is a smart group. My question would be, is number 6 preferred or not? Because in the IRS audit guide, it's listed under the preferred methods, but then it tells you don't do it this way because it's hard to substantiate. So the reason I bring this up is there are some online tools out there to do cost segregation. It's kind of like the TurboTax of our industry, if you will, where you can go online, input a few numbers. They're going to ask you a few questions about your property. You pay like $1,000 and it spits out a report. What I found is those reports are very conservative, number 1. And so you end up leaving quite a bit of tax savings on the table. The reason they're conservative, I think, is because they do get challenged by the IRS quite often because they don't meet the strict guidelines in the audit guide. There's no site visit. Nobody's going out to actually confirm that there are appliances in the building or that there is carpet. And so they kind of get around it by being super conservative. But then again, you leave money on the table. So just be cautious of that. There is a time and a place for those types of studies on really small properties. You know, maybe you're buying a house that needs to be refurbished. You bought it for $80,000. It might not make sense to do a full engineering cost segregation study. So you go online and do an online version. But for anything with basis over about 250,000, it's definitely more beneficial to do an engineering-based study because the overall tax savings is going to be significantly more, even when you factor in the cost of that detailed engineering approach. So just wanted to make that clear and kind of talk about the different methodologies there. All right, so when we are doing a detailed engineering approach, how do we identify what can be segregated in a building? The IRS has given us this section of the code, section 38, where they tell us how to identify personal property. And there's really 3 tests we're looking at. The first one is if the property can be removed without damage to the structure or building. So in that example there, you see a picture of a chandelier. I could easily take that chandelier down without damaging the structure of the building. Here in this office, this window covering behind me, I can take those window coverings down without damaging the building or the structure. That's the first thing. Number 2 is if the relationship between the asset and equipment or machinery is so close that they would be retired at the same time. So you guys can't see here, but there's actually a television on the wall just above me here. And that television is a short life asset. So it's a 5-year asset. But not only is the television a 5-year asset, but so is the electrical work going to that television. So there is a plug in the middle of this wall specific for that television that has electrical, it's got conduit, all the way back to the circuit breaker. I can put a value to that electrical work and I can associate that with the 5-year TV, which allows me to depreciate not just the TV, but also that electrical work. So I want you to think about, for example, an apartment building. How much of the electrical work going into an apartment building, or even like a duplex, how much of that electrical work is specific for short life assets? Things like garbage disposals, ceiling fans, appliances, range hoods, microwaves. Sometimes it can be as much as 50% of the electrical that's coming in, or electrical work that is put into a building is specific for short life assets. And so that's what we do in our cost seg studies. We identify and say, okay, what's the value of that electrical work going to the washer and dryer? What's the value of the electrical work going to the dishwasher? And we get to depreciate that over 5 years versus 27 and a half. So if you invest in commercial properties, you can use the example of like a industrial warehouse. Maybe you've got a piece of equipment, but you've got to pour a cement pad to put that equipment on. Well, that cement pad now becomes part of that equipment. Maybe you've got to run electrical to the equipment and you've got to run some plumbing to keep that equipment cool. The electrical and the plumbing all becomes part of that piece of equipment. And so you can see how cost segregation can get complicated real quick because we need to put a value to all those different pieces of equipment that go into that larger piece of equipment so that we can maximize the deduction. And then the last one there is the relationship between the asset and the nature of the business are unique. I'll give you an example there. We did a cost seg study on a meadery. I don't know how many of you know what mead is. I didn't at the time, but mead is a fermented honey that they take honey, they ferment it, it makes an alcoholic beverage. It's kind of like a honey wine or a honey beer. And of course, this meadery was down in Phoenix, Arizona. It was 120 degrees in the summertime. We went down to do the site visit. It was sweltering hot. We went into the warehouse and there was this specialty HVAC equipment that kept these 50-gallon drums of honey cool and at a certain temperature. As you can imagine, in Arizona, it gets very hot, and so this honey gets very runny and it's hard to work with. And so they had to have this specialty AC equipment to keep the honey at the right temperature. Well, normally HVAC equipment to keep you and I cool in a building like this is part of the structure or part of the 27 or long life assets of a building. But because this HVAC equipment was specific to keep the honey cool, we were able to reclassify that as equipment and depreciate it over a much shorter useful life than 39 years. So sometimes it's not a matter of what the piece of equipment is, it's more a matter of how that piece of equipment is being utilized on whether or not we can accelerate the depreciation on it. So those are kind of the 3 rules we're looking at when identifying short life assets. Here's some examples here. Over here on the right-hand side, we've got our personal property. These are the 5 and 7 year buckets. You've heard me mention things like carpet, countertops, cabinets, blinds, windows, blind and window coverings, parts of the lighting, parts of the plumbing. Here in the middle, we've got our land improvements. These are things like parking lots, curbs, gutters, asphalt, concrete, storm drains, irrigation systems, retaining walls, trees, bushes, and shrubs is kind of interesting. If I was doing a cost seg study again on this office building, I'd actually go outside and count all the trees, bushes, and shrubs throughout the property, put a value to those trees, bushes, and shrubs, and depreciate them over 15 years versus 39 years. And so a lot of people don't realize that. Now, if your building backs up to a forest, for example, that would not apply. We don't get to count all the trees, bushes, and shrubs in the forest because those were there before the building. It's basically your landscaped improvements that we can count. And then over here, we've got all of our 39 or 27 and a half year assets. Again, this is the structure of the building, steel structure, roof, walls, doors, windows, HVAC, etc. Usually when we do a cost segregation study, we can identify about 30% into these first 2 categories, the 5, 7, and then again, the 15. So if you've got $1 million property, we're going to find about $300,000 worth of stuff that can be recategorized from a long life asset into that short life asset so that we can front load it and depreciate it at a much faster rate. All right, let's jump into a case study here. This is a retail office building, well, retail/office. It was built for $1.325 million. It was put into service in 2024, and the current tax year is 2024. We went in, we identified the different components of the building, and here's what we came up with. So in our case study, we found that $159,000 worth of 5-year assets were in the building. So again, these are things like carpet, countertops, etc. We found $39,000 worth of 7-year assets, $198,000 worth of 15-year assets. And here's what the depreciation schedule looks like. So over here on the left-hand side, this is your depreciation without cost segregation. So if we take that 1.325 building value, the purchase price minus the land, that's our depreciable basis. If we take that 1.325, divide it by 39 years, essentially you're going to get a $33,000 write-off every year for the next 39 years, which again, that's a great write-off, but I want a bigger deduction at a faster rate. So because of that, I did a cost seg study. We identified the $159,000 worth of 5-year assets, the $39,000 worth of 7-year assets, and $198,000 worth of 15-year assets. And now we're depreciating this $159,000 over 5 years, our $39,000 over 7 years, and $198,000 over 15 years. And that's what you see here. Now, when we do that, we are able to front load or take a much bigger deduction in these early years. So this is our new depreciation amount over here. So in year one, now year one's unique because this is partial year of ownership. And so we've got 16,000. We only owned the building for about half the year. So we've got a $16,000 write-off in year one. But when we did a cost seg study, we now have a $59,000 write-off. In year two, which is our first full year of ownership, instead of a $33,000 write-off, we now have a $69,000 write-off. And you can see it's not until about year 2027, it looks like, where we're actually getting slightly less. We're getting a $28,000 deduction versus a $33,000 deduction. So we're getting a little bit less here, but that's okay because all of this tax savings I now am carrying forward. I get to take all that money, reinvest it, and put it into other assets. So this is basic cost segregation. We haven't even touched on bonus depreciation. And like I said earlier, bonus depreciation essentially puts cost segregation on steroids. And so we'll get into an example here, but I just want to make that clear. These numbers are going to go up significantly when we add bonus depreciation. But even before bonus, we were doing cost segregation and creating large deductions in these early years. All right, so I've mentioned bonus. Some of the additional benefits of cost segregation, as I mentioned, is one of them being bonus. Again, it puts cost segregation on steroids. We'll talk about that here in a second. The other thing is something called catch-up depreciation, which is the ability, as I mentioned earlier, to do cost segregation on assets that have already been placed in service. So again, you bought a building in 2017, you never did cost seg. You can now do cost segregation, bring all that missed depreciation forward, and drop it on your current tax return. We touched on the reduction of recapture on sale. If you remember, this is, again, when you sell it, you're not selling your dirty stained carpet for more than you bought it for. And then if we have time, we'll talk about partial asset dispositions. But let's first talk about bonus depreciation. Bonus depreciation has been around for a number of years. Again, bonus depreciation, the government uses bonus depreciation to stimulate the economy. So when the economy's not doing well, they'll go in and they'll increase the bonus amount. When the economy's doing well, they'll decrease the bonus amount. Bonus depreciation, if we go back in 2017, bonus was at 50%. And bonus could only be utilized on assets that had a useful life of 20 years or less, and they had to be brand new assets. So for example, in 2017, if I went out and bought a $1 million bulldozer and I was able to take 50% bonus on that, I would get $500,000 or 50% as a deduction in year one. The other 50% would be spread out over the useful life of that bulldozer. And again, it had to be a brand new bulldozer, not a used bulldozer. That's an important piece to note. Again, the government wants us to go out and stimulate manufacturing and whatnot, so they said it's got to be brand new. Well, fast forward to the end of 2017, Donald Trump was our president at the time. Donald Trump revised the tax code, and Donald Trump owns real estate. And so the tax code was very favorable to real estate investors, and a couple of things changed. One is bonus depreciation went from 50% at the time to 100%. So as you can see here, any asset placed into service between 9/27 of 17 and 12/31 of 2022 was eligible for 100% bonus. That's the other big piece. It went into 100%. Number two, or excuse me, it slowly phases out after that. So starting in 2023, it went to 80%. 2024, it went to 60. Here in 2025, we're currently at 40%. I do want to add that there has been talks. I don't know how many of you guys listened to the president's address to Congress the other night. He actually mentioned that they were bringing back or hoping to bring back 100% expensing, I think is how he phrased it, which is basically bonus depreciation. He mentioned that they were going to try to retro date it for January 20th of 2025. Now, those are all his thoughts. They haven't been passed by Congress yet, so we've got to put this through Congress. Congress might make some changes, they might not, but if the president were to have his way, it'd be 100% bonus taking effect on any assets bought after January 20th, 2025. So saying that, we'll have to wait. Hopefully Congress can get their act together sooner than later, and they can put the bill in front of the House and the Senate. They get it passed, and then we'll be able to start tax planning for that 100% bonus. But worst case scenario, nothing happens and we're stuck at 40. But again, 40% is still very good because again, we were doing cost seg when it was at 0, but 40% is not quite as good as 100%. So we'll wait and see where we are on that. Stay posted. I know Anderson will probably be putting out some content around that once that tax law takes effect. So that was the first big change. Went from 50% to 100%. The other thing that happened with the Tax Cuts and Jobs Act in 2017 is they added 5 words to the tax code. And I'm not sure that the folks in Congress who voted for it even realized the impact of these 5 words, but they added the words new to you, the taxpayer. And what that means is I no longer have to buy a brand new bulldozer to be eligible for bonus. I just have to buy a bulldozer that's new to me, the taxpayer, which essentially means I can go buy a used bulldozer. It's new to me, the taxpayer. And now all of a sudden I'm eligible for 100% bonus. So let's stop there. I don't know how many of you guys invest in bulldozers, but let's put this in terms of real estate, because I think that's why we're all here. So what that means is starting at the end of 2017, I don't have to build a brand new duplex in order to take advantage of bonus. I just have to buy an existing duplex. So if I buy an existing duplex, I do a cost segregation study. I identify those short life assets, the 5, 7, and 15-year stuff. Because remember, in order to take advantage of bonus, you have to have a useful life of 20 years or less. So if you buy a single family home and you don't do cost segregation, then that single family home is depreciated over 27 and a half years, which means it's not eligible for bonus. If you do a cost segregation study, you identify the 5, 7, and 15-year stuff, all of a sudden it is eligible for bonus. So huge, huge difference. This tax law alone made cost segregation a lot more applicable to a lot smaller investor. So now you didn't have to have $1 million building. Now, if you had a $300,000 single family home, remember I said we usually segregate around 30%. So 30% of a $300,000 home, let's call it 100,000. And that 100,000 of short life assets, you're now eligible for 100% of that as a deduction in year 1. You essentially could buy a $3,000 home and have a $1 million deduction a $300,000 home and have a $100,000 deduction all in year 1. And so that was very powerful. Now in 2023, if you bought that same property for $300,000, we would go in, we'd identify that $100,000 of short life assets, and you would get 80% of that, or $80,000 as a write-off. Following year, 60, etc. So again, cost segregation, very powerful. Bonus depreciation, we call it super bonus. You'll see across the top. I don't think that's a technical term. I probably wouldn't Google that on the IRS's website. It's not going to come up with anything, but it is super in the fact that we can front load or take huge deductions in the early years. Now, the nice thing about this, actually, I think I'll talk about that here on the next slide. The nice thing about this is you can see our new depreciation amount over here. So in year one, instead of getting a $16,000 write-off, we actually got a $269,000 write-off. That's a difference of $252,000. If you're in a 35% tax bracket, that's an $88,000 tax savings. Now you can see, if you remember, we had $159,000 worth of 5-year assets. So in this case, because this building was put into service in 2024, we're eligible for the 60% bonus. So we're going to take 60% of this number, 60% of this number, and 60% of this number all in the first year. And you can see that here in the chart. I've got 108,000, 26,000, and 123,000. Now, the rest of that gets spread out. The rest of that, meaning the other 40%, gets spread out over the useful life of that asset. But we're taking a huge bump here in year one and getting a significant tax savings there. So if this was in the year of 100% bonus, you would get the full 159 in year one, 39,000 in year two, and 198,000. So you wouldn't see any of these numbers here, here, or here, because you're getting the full write-off all up here in year one, which is creating a massive, massive deduction. Now, some of us maybe don't need a $269,000 deduction. And so the IRS will actually allow you to opt in or out of bonus depreciation by class life. So a lot of investors will say, hey, I want my 5 and 7 year assets to spread out evenly or somewhat evenly over 5 and 7. It's not exactly even, but I don't want to front load or take any bonus depreciation, but I do want to front load my 15 year because I'm not going to own my building for 15 years. So what I'm saying is that cost segregation gives you the ability to kind of manage your deductions so that you're maximizing your tax savings. And so that's very powerful. It's a great tax planning tool. The other thing is you don't have to do cost segregation in the year you buy the asset, which again is another tax planning tool. You just kind of keep it in your pocket until you have a high tax year or a high income year, and then you implement the cost segregation study in that year. And I think we'll actually talk about that now. So catch-up depreciation or a catch-up benefit, sometimes people will refer to these as a look-back study, is the ability, again, to do cost segregation on an asset that's already been placed in service. So I bought a building in 2017, didn't know about cost segregation, or maybe I didn't need the deduction in 2017. I can now do the cost segregation study here in 2024. Well, we're in 2025, but for my 2024 taxes, bring all that missed depreciation forward and drop it on my current tax return. And it does require an additional form. There's a 3115 is the name of the tax form. And it's a change in accounting method. And basically we're telling the IRS that we're changing our method of depreciation. And it's interesting, we're actually checking a box on there that says we're going from an impermissible method of depreciation to a permissible method. So again, we're telling the IRS, hey, I screwed up. I was depreciating my carpet over 39 or 27 and a half years. I should have been depreciating my carpet over 5 years. And here's the difference in those numbers. And again, it allows you to bring all that forward. It's called the 481A adjustment. Allows you to bring it all forward. You don't have to go back and amend any prior years. So here, I know there's a lot of numbers here, and hopefully you guys can see these on your screen. Here's an example of one of the schedules from our study. But let's take that same retail office building, the $1.3 million building from the case study, but now let's say that it's been in service since 1/1 of 2016. So it's been in service for 8 years. Down here, you'll see we've got our $1.3 million of building. We had our $159,000 worth of 5-year assets, $39,000 worth of 7, just like in the example before. Well, for the last 8 years, I've been taking my standard deduction, my 1/39th of a deduction. So I've taken a total of $383,000 of depreciation. When I did the cost seg study, I determined that I was eligible for $498,000 And that gives me an additional deduction this year of 115, or that's my catch-up depreciation. So that's the missed depreciation I've had over the last 8 years. But then I also get this where it says current year depreciation. So I'm actually taking the 35,000 plus the 115, and that's my total deduction for this year. So it's really about, what is that, 150. And that's bringing all that forward. I'm offsetting my income by 150,000 this year. Now, we should touch on something, and I failed to talk about this earlier. Cost segregation for most of us, I shouldn't say cost segregation, depreciation on our real estate assets for most of us is going to be considered a passive deduction. So passive deductions can be used to offset passive income. So for me, I'll use myself as an example. I'm a W-2 employee here at Cost Segregation Authority. So I have a rental property, a long-term rental property on the side. And if I do a cost segregation study on my long-term rental, I cannot use those deductions to offset my active W-2 income. Again, I'm a W-2 employee. My wife's a W-2 employee. She's with the school district. And so these deductions, if this was me, for example, I couldn't use this $115,000 to offset $115,000 of my cost segregation income, because these are passive deductions and this is active income. So a lot of you guys, I know Toby talks about this a lot, about the real estate professional. If you become a real estate professional, you or your spouse, then all of a sudden these deductions can be used to offset my W-2 income. So if my spouse was a stay-at-home spouse, she managed our rental properties, and she could prove that she spends at least 750 hours a year doing real estate activities, as well as 51% of her working time, and that she actively participates in the management of our properties, then that she would qualify as a real estate professional. We would file a joint tax return, and all of a sudden these deductions can be used to offset our active income. So that's one way. The other ways that I know of, and Toby may know of some more, one is the short-term rental loophole. So I hate to use the word loophole because it's not actually a loophole, it's just the part of the tax code. But again, I'll use a real life example. In the end of 2022, had a tax liability. I was going to owe some taxes. I had my long-term rental, but I knew if I did a cost seg study on that, I couldn't use those deductions. So I actually went out at the end of 2022 and bought a short-term rental. I managed that short-term rental through the end of the year. I bought it in November, managed it through the end of the year, spent 100 hours on that property, because there's seven tests. You have to meet one of the seven material participation tests. I met the test that said I spent 100 hours at the property and more time than anybody else. The other piece is the average stay has to be less than 7 days. So we had a number of renters come in through the end of the year. We took the total number of days we rented it out, divided by the unique number of renters or people who stayed at the property, and it was less than 7. So that qualifies it as a short-term rental. And the way I look at it, or the way the IRS, I believe, looks at it, is I don't really own real estate. I more own a hotel. Now, it's only a one-person or a one-bedroom hotel. It's an Airbnb property. It's not like a large hotel, but essentially it gets treated like a hotel because, again, the average stay is less than 7 days. And I was basically managing or running that hotel business. All of a sudden, those deductions do become active, and they can be used to offset my active income. So that's the other way I know to get around it. And then there's another thing called a grouping allocation, where we do this oftentimes for like a dentist or maybe somebody who owns a roofing company. If you operate out of that piece of real estate, so again, let's say I'm a dentist and I buy a medical building, and my practice operates out of that medical building, oftentimes I can group those two activities together, my operating company and my real estate company. And I can say, hey, the only reason I own this real estate is because I need a place to practice my dentistry. And the IRS says, well, okay, well, that's now part of your business. And they allow you to use the deductions to offset your operating income. So there's probably some other ways around that, but just keep that in mind. And it's always important to talk to your tax professional to make sure that these deductions, we can create the deductions all day long, but if you don't have income to offset or the right type of income to offset, then sometimes cost segregation doesn't make sense. So just keep that in mind. I wanted to make sure we pointed that out. And again, Toby can probably add some color to that here in a moment when we get done. All right, so some things to consider on cost segregation. Number one is what types of properties are worth looking into. Again, any revenue generating property with a depreciable basis over about 250,000 is worth looking into. Most cost segregation companies out there, including ourselves, will do a free benefit analysis where we will run some initial numbers for you before we ever engage you or ever charge you a dollar. We want to make sure that, yes, in fact, this is a good property. And yes, in fact, you can use the deduction. So we'll get on the phone with you and your tax preparer. We'll say, hey, we can create this $150,000 deduction. Can Johnny use this deduction? If so, then we move forward. But we always want to run the numbers first. So I would say anything over about 250,000 of depreciable basis is worth looking into. Anything less than that technically is still a candidate for cost segregation, but the tax savings might equal the amount of fee that is going to be required to get the study done. And so it doesn't always pencil out, but that's just something to keep in mind. When does it make sense to do a cost segregation study? Anytime you own real estate and have a tax liability, it's definitely worth looking into. It's not a matter of if you should do cost segregation. Typically, it's a matter of when you should do cost segregation in order to maximize your tax deduction or your tax savings. So remember, you want to use cost segregation or depreciation in years where you have higher income and you find yourself in those higher tax brackets because your overall tax savings is going to be higher. And then the last thing here is, what items do I need to provide for a cost segregation benefit analysis? Typically, we need a closing statement. So if you bought a property this year or even last year and you haven't filed your taxes yet, we would just need a copy of the closing statement, or we would need a copy of the depreciation schedule. So if it's a building that was placed into service in a prior tax year, we would just want to see a copy of that depreciation schedule to determine how much depreciation you've already taken and what the land value was, what the depreciable basis was, what the in-service date was, so that we can then run some numbers that are accurate. So those are kind of the thing. And then, of course, we need a building address so we can look it up online and get an idea of what type of building it is so we can give you some accurate numbers. That's really it on cost segregation. I do want to just pull into the screen here a actual example that I pulled earlier today. Let me see if I can make this larger. This is an example of an actual Anderson client. You can see down here in the bottom, they bought this property for $545,000. We determined the land was $126,000. So that means the depreciable basis was $418,000. So that was our starting number. Of that $418,000, we determined that there was $106,000 worth of 5-year assets, things like flooring, wall covering, ceiling fans, appliances, etc. Not a lot of 7-year assets. There usually isn't. This is kind of your telecommunication lines. So there was just a small amount there. But then on our 15-year, there was about $38,000 worth of outside stuff. So that number's a little bit low. So maybe this was more of an urban setting. There wasn't a whole lot of landscaping. But when we did a cost segregation study, remember this building was placed into service on 9/1 of 2021. So if you remember back to that bonus depreciation table, bonus depreciation at the time, your bonus depreciation amount is dependent upon the year you put the building into service, not the year you do the cost segregation study. So because this building was placed into service during a period where there was 100% bonus, we were able to take 100%. So you can see we found $106,000 worth of stuff. The depreciation allowed through calendar year 2023 was that full amount because it's 100%. The client had only taken $8,000 of depreciation, or $8,800 exactly, on these 5-year assets because they were using the straight line method, which means we were able to catch up $97,000 of additional deduction. On our 15-year assets, we were able to catch up 166. On our 7-year assets, on our 15-year assets, we were able to catch up 35,000. Our total catch-up amount down here at the bottom, or that 481A adjustment, was 133,000. Plus, we got the current year stuff, the current year deduction on this long life asset category. So in this example, we were able to increase depreciation in the year of doing the cost seg study by about 142,000. So I've got my calculator here. If I'm in a 30, let's call it a 35% tax bracket times $142,000 of additional deduction, that's about a $49,000 tax saving. And again, this was on a $500,000 asset that they had bought in this example 4 years ago, 3 years ago. They bought it in 2021. The study was done for 2024. So very powerful stuff. So again, if you're meeting with your tax preparer, you've owned assets, your tax preparer says, hey, you're going to have a big tax liability. It's worth looking at those assets you've owned to see, hey, can we do some cost segregation work to be able to front load or take some of this missed depreciation and drop it on our current tax return. So I just wanted to give you an actual real life example. That was actually a residential rental that we had done the study on. So I have 2 more slides. I do want to talk about 179D real quick. 179D is a deduction that's available to developers who are developing commercial real estate. So it has to be commercial. Typically, it has to be new construction. There have been a couple remodel projects where we can qualify for portions of it. But for the most part, this would be for anybody who's building new commercial buildings. If you build them to a certain energy efficiency standard, then the IRS will issue a deduction, an additional deduction of up to $5.65 per square foot. So probably one of the most underutilized deductions. There is a prevailing wage requirement to this, meaning you have to pay your contractors a prevailing wage or a minimum wage that is dictated by where the project is being constructed. So you go to a website, it's actually sam.gov, www.sam.gov. You put in the county where your project is being built, and it'll give you the exact dollar amount that you need to pay your electricians, that you need to pay your plumbers, your landscapers, your laborers. Gives you those wages. And if you're meeting those wages, number one, and number two, if your building meets certain criteria, essentially you do have to have a third party come in and inspect the building. And what we're looking for is we're looking for energy efficiency in the mechanical, which is your HVAC, your heating and air. We're looking for energy efficiency in your building envelope. So the exterior walls, the windows, the insulation of the roof, the attic, the walls, etc. And then we're looking at the lighting. Those are kind of the 3 big factors. There's a number of other smaller factors, but the 3 big factors that we're looking at. If your building meets certain energy criteria, actually, if your building reduces the energy consumption by 50% based off of a 2007 standard. So I want you to think about that. If you're building a building here in 2025, it's being rated against a building that was built in 2007. So it's not extremely difficult to qualify for these. The hardest piece, which is a new part of the law, which is the prevailing wage requirement, you're still eligible for this deduction if you're not paying prevailing wage, but you only get about 1/5 of it if you don't pay prevailing wage. So in order to maximize it, you do want to make sure you're paying prevailing wage. But if you have a third party come in, we do the modeling, we determine that your building is energy efficient, we can go ahead and issue a certificate which allows you to take, again, up to a $5.65 per square foot deduction that comes right off of the top of your building. So it's just like an additional depreciation expense. This, again, the IRS uses the tax code to incentivize people to do what it is they're trying to accomplish. And they want to give people incentive to build green energy or energy efficient buildings. And so that's the whole idea behind the 179D program. So again, we're not going to get too far into it, but if you are building or renovating new commercial space, typically over about 35,000 square feet, then the 179D may be worth looking into. The IRS also has their program for their residential units. So a similar program, it's called 45L. Keep in mind, this is actually a tax credit. If you remember, the 179D was a deduction. This is a tax credit up to $5,000 for the construction of energy efficient residential units. So if you're building a fourplex or a building single family homes, you may be eligible for up to a $5,000 credit per door or per dwelling unit. Similar type criteria, we're looking at the building envelope, the heating and air, the lighting, the insulation, the rating on the windows. And if it meets certain qualifications, then you're eligible for up to a $5,000 credit. You do have to have a third party come in, and there is also a prevailing wage piece to the 45L credit. The Department of Energy had something called Green Energy or Energy Star. Some of you guys may be familiar with that logo. Maybe you've seen it on your refrigerator or your dishwasher. There's a little logo with a star. That's the Department of Energy's program. It's called Energy Star program. The IRS had their 45L program, and they said, well, this is silly. Why are we two federal agencies trying to accomplish the same thing? Let's merge the programs. And so starting in 2023, your homes now have to meet Energy Star criteria in order to be eligible for the 45L. So prior to that, it was a little easier to qualify. But again, with some of the building codes that municipalities are requiring now and the material that is being used, it's not too difficult to qualify, and it's worth looking into. So just keep that in mind. If you or anybody you know is building residential units, apartment buildings, single family homes, duplexes, etc., they may be eligible for this credit. So with that, that's all I've got. This website here, www.andersonadvisors.com/CSA. If you guys go to that website and enter a little bit of information, it will notify us here at Cost Seg Authority that you're interested in running some initial numbers on a property. We'll do that free of charge. It doesn't cost anything. But if you have a property and you want to know if it's eligible and if it makes sense to do cost segregation, go to that website, fill out that form. One of us will get back to you, usually in about 24 hours. We will run some initial numbers that you can share with your Anderson advisor or your tax preparer, and we can help determine if it makes sense. But that's something we want to make sure we throw out. I think they'll probably add that in the chat notes again, but it's just www.andersonadvisors.com/CSA. My contact information is here. Please use me as a resource, guys. We don't bill by the hour. We're kind of a niche accounting firm. We don't do tax returns at our firm. So if you have questions on child tax credits or earned business income, I'm going to direct you back to Toby because I don't know anything about that stuff. But if you've got questions on depreciation, I think the weirdest question I've been asked is how to depreciate deer at a breeding facility in Wisconsin. And I didn't know the answers, but I was able to get the answers for our client at the time. So please, that's my contact information there. Don't hesitate to reach out if you have any questions. And I think with that, Toby, we'll go ahead and turn the time back over.
Yeah, we got a bunch of questions. So,
Okay,
yeah, I'm just going to clarify something because there was a whole bunch of people asking the same thing.
sure.
When you do a cost seg study, let's say you did it now, we could do a cost seg study for 2024 all the way up until we file our tax return. But you're not amending your returns previously. You're grabbing the depreciation for 2024 because the reason we can't go back is because A, they don't have carryback losses. Like we can't create losses here and carry them back. We were able to do that during COVID. We had a 5-year carryback, and then the famous Trump return where he did a cost seg on his building. He carried back 5 years under the Obama administration and got back a whole bunch of taxes he paid, and it, melted people's minds when they saw his return that he got like 90 million back. All you're doing is saying, hey, rather than carry forward the depreciation, I'm going to go back. Well, there's none of that right now. So this is all forward looking. So if you have a property that you bought in 2019, you put it into service and you did not do a cost segregation study, you could do the cost seg study today for 2024, and you could grab the depreciation that you didn't take and we could apply it to your 2024 taxes. We're not going back and amending, but like I had probably 10 questions on that where they were like, well, can I go back and can I, it's like, no,
Yeah.
we can
No,
go.
you don't. Yeah, you don't have to go back. The IRS allows you to do that using that 3115 change in accounting method. And there's a number you put on there and you get to bring all that
And it has to be
miscommunication forward.
timely made. You don't get to go back and amend returns and make it.
Exactly.
That's the
Yep.
problem with it. Otherwise, yeah, we'd go back and we'd say, hey, 3 years back, we'll go back and amend the returns. It doesn't work that way. Now, if you made a change of accounting election and you still were doing 20, everything under 27 and a half years, then you could go back potentially and amend and say, oops, I didn't break the property into its pieces, but I don't want to get that complicated. Here's the easy thing for you guys to do. Use the link for Erik and have them do an analysis. And they'll tell you, hey, based off of what you got, here's your options. I can't say enough good things about Erik and his company.
No, I appreciate it. Thanks, Toby, for the opportunity. And like I said, guys, if you're listening, don't hesitate to use this as a resource. We want to be here to help you guys. So we're happy to answer any questions that maybe Toby doesn't get to. Reach out to me directly and I'll get back to you.